price action. And price action is really reading and understanding what price is telling you on a chart. Now, there's many ways that you can read what a chart is trying to tell you. Now, today I'm not going to get started breaking down line charts, bar charts, and candlestick charts. I'm not going to get down with the real basics because the assumption is that you know most of the stuff. Now, I'm going to share a quick presentation with you on the charts, and then we're going to get on and talk about how to use these and read the price action. But I just want to bring everybody up to speed.
A price chart can be thought of as a record or sequence of prices where trades took place between buyers and sellers that are recorded on a chart for a stock or a market. Because price charts provide an easy-to-read graphical representation of a stock's price moves over time, price charts are a valuable tool to analyze any market. In future videos, we will cover how to use price charts to predict where a stock is likely to move, because if you know when a stock is likely to move higher or lower, you can potentially make big money. For this video, however, I will introduce 3 of the basic types of price charts commonly used in the markets. The first chart, and possibly the most basic price chart, is known as the line chart. The line chart represents the closing price history for a stock or for a market over time. Now, when we say that a line chart plots closing prices, we mean that the line chart plots the last price traded for each defined period, like for each 60-minute period, or for each daily session, or for each weekly time period. We can choose to look at shorter time periods or longer time periods when plotting line charts. When looking at a line chart, you can visually detect basic trends in prices along with the overall trading range where prices have traded over recent history. Because line charts only offer limited information, they are generally not widely used by traders in the markets. Let's move on to the next type of chart, the bar chart. Let's begin by understanding what each price bar represents. Think of a price bar as a clever graphical depiction or summary of where prices traded for some defined period of time, like for a daily trading session, where each price bar represents a summary of where prices traded during a daily trading session. The left tick mark on the price bar represents where prices opened for the session. In this case, the daily trading session for stocks, which trades from 9:30 a.m. to 4 p.m. New York Standard Time. The range of the trading session represents where prices traded during the trading session. The range is represented by the vertical line extending from the lowest price to the highest price traded during the trading session. The closing price, or the last price traded for the trading period, is represented by the right tick mark on the price bar. Bar charts are also called OHLC charts, or open, high, low, close charts, for the obvious reason that they graphically depict information related to the open, high, low, and close of a trading session. When we plot a bar chart, we can see price bars from a large number of trading sessions over a longer period of time. Again, each individual bar can represent any period we want, including a 5-minute period, 30-minute period, 60-minute period, or even a daily, weekly, or monthly period. Because of this, bar charts are very flexible to analyze short-term market conditions along with longer-term market conditions as well, which would explain why bar charts are possibly the most widely used chart in today's markets. Another price chart that has gained popularity in recent years is the Japanese candlestick chart. The candlestick price chart originated from Japan several hundred years ago. A number of Japanese rice traders were rumored to have accumulated incredible wealth from using candlestick charts to predict the future direction of rice. As you can see, each candlestick uses color to communicate the direction of price movement during each trading session. A green candlestick represents a trading session where prices opened and then traded higher through the end of the trading session. A red candlestick represents a trading session where prices opened and then traded lower through the end of the trading session. As you can see, each candlestick bar communicates similar information compared to price bars, both containing information related to the open, high, low, and closing prices of the trading session. As you spend time analyzing these price charts, you will discover that they contain a wealth of information about the behavior of buyers and sellers in a market. You will find that these different price
Okay, so we got that out of the way because I wanted to make sure everybody was up to speed and understood the different types of charts. Because now we have to talk about price action. And the only way we can see price action is on our chart. So let me pop up a live chart here for us. And we're going to be looking at, in a second, there we go, the euro dollar chart, the 30-minute chart. Now, this is my standard teaching chart. Now, like we just saw in the presentation, we have a line chart. Forget line charts. Don't spend your time with them. They tell you nothing. Okay. Now, I am on the whole a bar chart trader. I trade from bar charts, not because they're better or worse than candlesticks. Back when I started trading in 1972, we had to do all of our charting by hand. So we would sit there in the pits with graph paper on our laps and drawing our little lines on. The markets moved a lot slower in those days, and there was a lot less markets, and we only traded a couple handful of assets. But you would have to draw your bar or your line or your prices on each chart. So a bar chart was what everybody on the whole used. And even when online trading started, we had very few people using candlestick charts. But with the development of HTML and Java charts, candlesticks became the darling of online trading. So you can use either, and our charts today allow us to bop back and forth between them. But ultimately, whether you're using a bar chart or a candlestick chart, there's only 4 pieces of information they're representing: the open, the high, the low, and the close. Now that open, high, low, and close in the time frame you've selected is price action. It's trying to tell you a story of what price is doing. Now, how do we interpret that price? Where do we start out looking at our charts? Well, once you've decided what chart works best for you or what chart you want to use, and like I said, you can bebop back and forth between them all, you have to start making sense of what you see on the chart. Now, on my chart here, okay, you can see these 2 blue lines and the red line down below. Now, these lines were drawn on a chart very, very long time ago. These are lines or levels of support and resistance. These should be on everybody's charts. Now, here we see a chart for the British pound. You can see these levels of support and resistance, and what will make you a better trader than the guy sitting next to you is the few things that you put on your charts that are left up to your own interpretation. Now, support and resistance come in many different fashions. There's even a pivot point indicator that does all the calculations. There's Fibonacci retracement tools that give you levels of support and resistance. You can get levels of support and resistance off of moving averages. But the only one that really matters when you really want to interpret what price is trying to say to you is what we call eyeballing. Okay. And you should, now once you've drawn your lines of support and resistance on your charts, they stay forever. And they will change as price moves up and down throughout that trading chart and throughout that trading day and that trading week. So what we're looking at here are the levels that I drew on these charts a long time ago, the last time or 3 times ago. And as you see, as I go back farther and farther, price move, you see all these lines coming up on my chart. These were levels that were strategically important to the price the last time the price was trading in this current range. So they stay on your charts. And once you have them on your charts, you don't have to keep fiddling them. Once you've placed them, they stay and they go. Now, I personally color code my lines of support and resistance. My shorter term ones are in blue. My more longer term ones are in red. My long term ones are in gold. And I'm constantly updating the colors as I see how important they are. Okay. But this is my own system. It's one I developed. It's my key and my legend for me. You can develop your own way. You can use broader dashes and dots if you want. There are major support levels and minor support levels. But what makes you better than that next trader is how you've put these on your charts. Okay, how you've interpreted them. So I come down to what I call eyeballing. It's a strange name. I came up with it. It's not a technical name. It's because you use your eyes to go back and look on your charts in the past to see where important levels for that asset were. It means looking at historic price action to identify areas where price has reacted or had a difficult time climbing above or falling below. Horizontal levels in trending markets are areas to watch for price action. So as you can see, when price is moving up a trend, let me get my marker on here. Price is pushing up and making a new high, because a good defined trend is a higher high. Then it's going to ease down and make a lower high. Then it's going to surge back up to make a higher high, come back down and make a lower high. And this is a well-developed trend. Well, each of these levels become support and resistance, because as the price moved up here, it hit that level and it resisted and it fell. Okay. What causes resistance? We don't know. There's no mathematical formula. It's a price level that as the price was moving, that the new buyers tend to hesitate because they thought the price was too high. And buyers who had bought at a lower price had preset their sell orders and they were taking profit. So the price eases back down to form a lower high and then finally reverses itself. And this level here, which was our old resistance, as price moves up to it and breaks through it. Okay. Now, as price is moving back up and moving to it, this is a key level that we are looking at to see what price is going to do, because price can fall back off of it. That's telling us that previous trend is probably exhausted, or price will break back through it and start moving to its next level of resistance. And this level will then become, from resistance, it will become support. So when the buyers get tired out again and moves sidelines, price will ease back down, and there's a good chance it's going to ease back down to that new support level. And these are where they come from, because then I can extend these lines way into the future. So I know that when price was climbing up and the euro was going from 110 to 111, it got stuck at 111. It got support at 111.10, and it was able to move up easily to 111.42. Then it bounced back down to 111.10. So I know that 111.10 and 111.42 are significant price levels that are important to traders in the journey of the euro. Even 3 months from now, 6 months from now, the next time it's in this price level, these prices aren't important again, and they'll come back into play. And what we're trying to do here is we're trying to read price action. We're trying to understand what the current price on our current chart, so not what it did last year, not what it did 6 months ago. We're looking at the wall. Let me pop up the chart again. Because the only thing that matters to us is really here and moving forward. So what we're concerned with is, what are the levels around the current price? I don't know why my chart's not letting me pull it up and down today. So once we have our levels of support and resistance on here, we can then look and see if they've held in the future, if they've held in the past. Because again, we can only trade moving forward. But these levels tell us what levels are important. So like on this chart, we can see that way back when we drew these levels of support and resistance, way back when, months and months and months ago, extending forward. And look how important these levels are right now to the current price. We can see that as price eased down and hemmed and hawed on this level, broke through it, came back up and got stuck back on this level, came back down and moved right back up to this support and resistance level. And we can see this. This is not something I've made up. This is all traders out there know. But the difference is how much time and effort you spend and how you define putting your support and resistance levels on your charts. And that's only the first step to starting to define price action. Because a lot of people can simply trade from support and resistance. When price bounces off of support or bounces off of resistance, you can trade it in the opposite way. When price bounces above, you can trade it in the opposite direction. But eyeballing is not difficult. It's just time consuming, especially when it's new. Once you've got all your lines on your, I don't hardly ever draw new support and resistance levels, except when an asset reaches an area or a price that it hasn't been at in a very, very long time. So support is the level where price finds it difficult to fall below until eventually it fails to do so and bounces back up. It's simply where many traders make trading decisions at this level. Resistance is just the opposite. So the way I try to explain it is these are the floors above your feet and the ceiling above your head if you stand in an elevator. So if you get in that elevator, the support is holding up your feet. And when the elevator starts to rise, that floor is pushing you up higher and higher. So to go to the next floor in that elevator, you've got to push through that ceiling above your head, and that ceiling, which was resisting you, becomes your new floor below your feet, and there's a new ceiling. When the elevator reverses and comes down, that same floor that was supporting you is now your resistance, because you have to break through that floor. Now, you don't want to get hung up on the term support and resistance because they reverse and change. So you could call them important levels, strategic levels, okay? But now that we know the role of support and resistance, which from now on we'll call zones, that's because support and resistance are not a given line. Now, as I said, when you draw them on your charts, you're going back and you're using your eyes and you're looking for levels that were important in the past. There isn't an exact price level you're going to get. You're going to look where there was lots of tops or lots of bottoms or lots of closes, and you're going to draw your line through that and move forward, because what you're isolating is a price level that was significantly important. When you start to say that the price was going to react at 111.42, this is where you get a little bit of an error. You need to say to yourself, this is a zone. Price is expected to react somewhere between a 111.40 and 111.43. Okay, so you could draw like I do on my chart here. Let me pop the chart back up here. So these are the trading zone. So it's when price in the past have bounced between these little levels. So I put the two lines above to give me an area or a zone. Okay. It's up to you and how you want to do it. Okay. I, in most cases, simply draw one line and my brain automatically gives it a couple pips one way or another. Where sometimes when you're looking at your historical charts, you'll see that there was actually a zone that was important in that price movement. And so you would draw on your two lines. Okay. So we can see all of these closes right on that bottom line right there. But when we look at it all, we can see it's this entire zone. So we have closes here, we have opens here, we have closes here. So this is where the zone came from. Now here is a single line where we have lots and lots of closes, tops and bottoms at this price, but it's only a single line, because how you draw them on your charts and what your legend is, how you're going to interpret them, is very important. But once we have them on a chart, then we have to figure out what to do with them, because we want to interpret price action. We need to interpret the story of what price is trying to tell us. Now, there are many more like zones that can be breached and pushed into. The trend may pull the price action back out of it, or maybe price action will succeed in breaking it for good. This is why we want to think of these points as zones. So this support and resistance zone strategy will enable you to take trades exactly at the area price will reverse. Trading support and resistance lines are critical for every trader to implement into their system. So I'm going to guide you every step of the way. Now follow along as we cover support and resistance trading. After you will learn the strategy, you'll be able to identify these sweet spots where price action happens. Now, our indicator for the strategy will be price action and its relationship to support and resistance. Now, to be honest, this is, in my opinion, the best way to trade support and resistance. So what exactly are these areas? How do you trade support and resistance? So let's go and take a look. Now, this is a single indicator. You need to combine it with other indicators when you're trying to interpret what price is telling you and to understand it all. But you have to start with something. Okay. So let's go. So what's the first step? The first step of support and resistance zone strategy is the first step of the strategy is drawing the zones on our charts. This allows us to easily spot where price would probably reverse. After you do this, it will resemble a support and resistance indicator, only now you have zones to take advantage of. This doesn't mean there is no rule, there's no law, there's not even a percentage that price will reverse at these levels. What we find is in most times as price approaches those levels, it may hem and haw for a second. You may have an open or a close right on that level while traders decide what to do. It's telling you that this is a price zone you need to pay attention to. Okay. Now, certain times, certain things come into play. But regardless of how you're trading, what your trend line tells you, you're now looking at what price is telling you. Because price is the only one that can tell you anything. Too many traders get hung up on all of these oscillators, indicators, and mathematical calculators. They're simply interpreters. Okay. They help you when you can't figure out what price is telling you. But if you can figure out what price is telling you, you don't need all those interpreters. So drawing the zones of charts is better done on a higher time frame and then move down to a smaller time. So like if you're a short time trader, like most of us, you would draw your support and resistance levels on a 1 hour chart, even though you're going to be trading from a 30-minute chart or a 15-minute chart, because this will give you better isolation of these zones. When you're doing support and resistance trading, a line with multiple touches is far better off as it stood against price and has passed the test of time, because history always repeats itself. And this continues to happen time and time again on every chart that you will ever look at. Now, before I go on, let me tell you two things. Okay, number one, if you look on your screen, I put together two handouts for you. The first one, now these are just PDFs. There's nothing you have to pay for, nothing you have to sign up for, nothing you have to do but click the download button or PDFs. The first one is a handout I put together for you on reading financial charts. Basically what we've touched on, what we've talked about. The second one is an incredible resource guide from investing.com on all technical analysis. This is a huge resource guide that you can download and then go back and check everything on technical analysis. Pick what you want, what you don't understand, what you want to learn about, just something you want to grab and then, okay, instead of searching the internet, you have your entire resource right there. Now, back to where we were. Make sure to leave spaces between your zones, as drawing many lines will confuse you. If you see lots of support and resistance levels or price levels are important, but they're all within a couple pips of each other. Drawing all of those lines on your chart just makes a mess. Now, once we've got our lines on our charts, the second step is identifying the support and resistance zones. So the second step is waiting for the price action to touch the zone. What you can do is set your charts to 2 or 4 currencies and wait for your chance, as it may take some time for price to reach the support and resistance levels. The reason we say 2 or 4 currencies is because this is a good number of pairs to be looking at. Too many of us want to look at 10, 20, have charts going on right and left. You can't be an expert, can't be watching all of these areas at one time. So the second step, basically the higher time frame takes less time and attention to the smaller time frame. Alternatively, the smaller time zone has more signals, as zones may get hit more frequently. You may have to be more focused if you're trading small time frame. Yes, it takes more of your attention, but we are trading in small time frames. So let's go back and look at my charts again. So now, for instance, here, I also have a triangle on my chart. Okay, but we saw price moving up to this price zone. We set that as a buy zone. We saw our resistance zone, and we were waiting for something to happen. We needed price to tell us what it was going to do. In this case, we also used our triangle because we got a breakout of the triangle. But support and resistance alone told us what price was going to do. Came up here to our what would have been our resistance level as it was moving up an uptrend, moved into our zone. And then what did it do? It stayed in our zone and then bounced out and continued to climb. This gave us a beautiful trading opportunity. Now, we would have set our next resistance level as our target, and we would have set our stop loss here, but it would have given us a perfect trade all along the way. And if you notice, each time it does this, it would have given us another trading opportunity in small amounts of profit. We're not looking to get rich over these trades. We're looking to make successful trades. Because we're trying to read what price wants to tell us. So here, let me just put a hypothetical line on here since it won't let me pull it up. So here we have price moving up, touched our support zone, bounce up, move back up, hit our resistance price, and now we're looking for an opportunity. Now, it wasn't able to muster any strength and continue up through that resistance and fell down below. So we're now estimating or looking for a price to fall back to this level here. And you could have traded each time the price moved up, moved down, moved up, moved down to successfully trade. Because once you validated that support and resistance zone and see that it's active and holding true, you could have had all these trades. Now we're looking at a 30-minute chart. So this would have given us a lot of opportunities over the last 24 hours. So if the price reverses, that will be good, as is what we are expecting. So when price moves up to that resistance level, we're expecting to reverse and move back down, not reverse the trend. A trend is a matter of pushes and eases, pushes and eases. So this could have been push, ease, push, ease, push, ease, push, ease, push, ease, push, ease, and continued its trend. It's not reversing. These are just the natural movements of price. So on the other hand, if it breaks that level, it may be really breaking at or a fake break. We should also see a strong piercing candle that effortlessly breaks that level to assure that it will continue in the same way. If it breaks that resistance level effortlessly, okay, means that we don't have a trading opportunity. And then step 3, the third step of this trading strategy is to wait for the candle which hit the zone to close. You never trade before the close of a candle. So what we had was the candle or the price that touched the zone closing. Okay. This will indicate the signal candle we were waiting for. So we want to look for that, and then we need to wait for the next candlestick before we can decide whether we actually have a trading opportunity. So is this a bullish or bearish candle? Is it strong or weak? Is it big or small? Does it have long wicks and small wicks or no wicks at all? So when we can identify the kind of candle that you can be able to decide whether to sell short or buy long. Knowing the type of candle is crucial to identify whatever the entry is valid or not. So what we're trying to do is read what price is trying to tell us. We're looking at price on our charts and interpreting price action. So in this example, we see how support rejected price and pushed back up. We also see the candle that formed afterwards to signal the end of the down movement and begin the upward movement. So how do we know it was strong, and what is the secret? Before we go any farther, here are some important factors in determining a strong candle. Because spotting that specific candle on its own makes the difference between winning and losing trades. What you're looking for when it's a bounce off is a strong bullish candle. The qualities of a strong candle are a long body, formed after the previous candle touched the level but could not break it. It's highly taken in the 2 previous candles. So what we had is this candle could not break the resistance zone, the support zone. The next candle bounced off, and we could call this an engulfing candle. It took out the 2 candles before. This is telling you, okay, let's buy. At that point, you would initiate a buy trade. So you see the difference between weak candles and strong candles. And this is helping us read price action on our charts. So here you can see that those weak candles were not able to breach the resistance line, and long wicks could not break that level. So we wait to see what will happen with the next candle. Will the price action break that level, or will the resistance win and will price reverse? So we have to look carefully at what that candle is trying to tell us. And then lastly, we need to combine that into our 4th step. The 4th step is to identify where you want to enter a trade. You want this to happen at the pivot point or the turning point. So here is the entry criteria. Your entry should be slightly above or below the signal candle, which is the strong candle. This way you are adding more confirmation to your trade to make sure that the price will move towards the direction you expected it to move. Our stop loss should be placed on the other side of the zone and not too close to that level to give it some space. As we said, it is a zone. So putting the stop loss there makes sense because this is the end of that trade. Okay. The price is unlikely to reverse after it bounces off of that point. So we would set our stop loss slightly below. We would enter on the confirmation candle and enter in the direction of that trade. So let's review. The support and resistance zone strategy will enable you to take trades exactly at the area price will reverse. trading support and resistance levels is critical for every trader to implement into their system. So we want to identify support and resistance trading zones. Now remember, this is a strategy that fits part of your trading system. Okay. Our indicators for the strategy will be price action and its relation to support and resistance. And to be honest, this is, in our opinion, the best way to trade support and resistance. So what exactly are these key areas? How to trade support and resistance? We've talked about it. So we want to draw these lines on our chart. We want to wait for price action to touch one of the zones above or below. We want to wait for the confirmation candle. We want to identify where we'll enter the trade and where we'll set our stop loss. And we want to identify our exit strategy. Our entry should be slightly above or below the signal candle, which is the direction the price is moving, which is the strong candle. This way you're adding more confirmation to your trade to make sure that the price will move towards the direction you had expected it. So folks, that's a wrap. We have learned from this support and resistance trade how to draw zones and how to trade them successfully. We've also learned how to determine the direction the price will probably move to, so you can have a better edge in your trading. And we've learned how to look at price action and read what the price on your charts is telling you. So in conclusion, trading support and resistance and discovering support and resistance zones are pivotal to your trading success. So thank you very much for joining us. Thank you for supporting Alvexo. And if you want to learn more about reading price action or trading support and resistance, go to www.alvexo.com. Go to their education center and you'll find all types of articles, all types of tutorials, all types of information on trading support and resistance. So have a great trading day, and thank you for supporting investing.com and Alvexo. Bye now.